All right, RAM Group agents, let's get right to it. Today, we're going to break down a really critical shift in business succession planning, one that has a huge impact on your clients.
So, let me ask you this. Could your client's buy-sell agreement, the very document meant to protect them, actually have a hidden tax bomb just waiting to go off? Because a recent Supreme Court ruling has completely changed the game. What used to be a standard, safe plan could now trigger a massive, and I mean massive, unexpected tax bill for your client's family.
Okay, so this is the new world we're living in. I know, it looks a little complicated, but don't worry about trying to absorb everything on this screen right now. We're going to break it all down, piece by piece, and give you a really clear, actionable strategy to protect your clients.
So here's our game plan for today. We're going to start by unpacking this new risk, then we'll pinpoint the exact tax trap it creates, and then, most importantly, we'll pivot to the strategic solution. By the time we're done, you're going to have a rock-solid plan for leading this conversation with your clients.
Okay, first up, let's talk about the event that changed literally everything.
So back in June of 2024, the Supreme Court's decision in a case called Connelly v. U.S. sent a major shockwave through the succession planning world. And the key finding is right there on your screen. The insurance money was not offset by the company's obligation to buy the shares. Now, this isn't some minor little tweak in the rules. No, this is a complete rewrite of how we have to think about valuing corporate-owned life insurance inside of an estate.
So what exactly is this trap, and why is it so incredibly dangerous for your clients? Let's dig in and break it down. For years, and you've all seen these, the entity redemption agreement was the go-to. It was popular, it was simple. The business owns the policies, pays the premiums, and then handles the buyout. It just seems straightforward, you know? Especially for companies with more than just 2 or 3 owners. Now take a look at how this process traditionally worked. It looks pretty clean, right? But I want you to focus on that critical tax note that's highlighted. That is the landmine. See, the court basically said that the second that insurance money hits the company's bank account, even for a moment, it becomes a corporate asset. And that inflates the company's value before the buyout actually happens. And there it is, that's the trap, laid bare. The very tool that was supposed to solve the problem, the life insurance policy, ends up poisoning the well. Those proceeds blow up the company's valuation right at the moment of death, which then inflates the value of the deceased owner's taxable estate. This can create a gigantic, unfunded tax bill for the family, completely wiping out the whole point of the plan in the first place. Okay, so we know the problem. It's scary stuff for sure. But the good news is there is a clear solution. So let's talk about the strategic shift that builds a much safer future for your clients.
The strategic pivot that we're recommending is a move to the cross-purchase structure. Now, this structure inherently avoids the Connelly trap, and is for one really simple reason. The entire transaction happens between the individual owners, completely bypassing the company's balance sheet.
It's a really elegant solution when you think about it. The surviving owners get the tax-free insurance money directly. It never, ever touches the company's books. And if the money never hits the company's accounts, well, it can't artificially inflate its value for estate tax purposes. The Connelly issue is completely sidestepped. Problem solved.
And this is where it gets even better. Take a look at this direct comparison. Not only does the cross-purchase get rid of that estate tax risk, but it also gives the surviving owners what's called a stepped-up basis. In simple terms, this means their cost for the new shares is the price they just paid, which dramatically reduces their capital gains taxes if they decide to sell later on. It's a powerful 1-2 punch of benefits.
Now, as great as this is, it's not all sunshine and rainbows. While the cross-purchase is definitely the safer structure, it's not without its own complexities, and you really need to be aware of them. The main challenge really is just administrative complexity. The number of insurance policies you need can grow exponentially, and it's all calculated with this simple but, as you'll see, powerful formula, where N is just the number of owners.
So let's put some real numbers on that. Let's say you have 6 business owners. You plug that into the formula, and boom, you're suddenly talking about 30 separate insurance policies. You can see how this policy count explosion can get really messy really fast.
But there is a potential workaround here, a trusteed agreement. This can simplify things a whole lot, basically bringing the number of policies back down to 1 per owner with a trustee managing the whole process. Now, and this is a big but, you have to be really careful with the specific tax rules here, especially when you're dealing with corporations versus partnerships. The bottom line is, if you are even thinking about this route, it's absolutely essential to get a specialized attorney involved right from day one.
And that brings us to the most important part of this whole thing. How do you take all this information and use it to lead a productive conversation and actually protect your clients? let's get into your action plan.
This right here, this is your playbook. Follow these 5 steps to guide your client through this new complex landscape. And notice that step 1 is build the team. Your role is to be the catalyst, the quarterback who brings the attorney and the CPA to the table. You're the one who makes sure the legal structure and the insurance funding are perfectly aligned to protect their legacy.
So the ultimate takeaway is this. The whole idea of a set-it-and-forget-it buy-sell agreement is dead. It's over. Proactive, regular reviews aren't just a good idea anymore, they are absolutely essential. And this is your opportunity to lead that charge, to protect your clients from this dangerous new tax trap, and to really prove your incredible value.